I've got something special for you tonight. We're going to talk about 9 critical factors to comparing oil and gas companies so you can start making money right away. The first factor is product mix. Does the company primarily produce oil, gas, or natural gas liquids, such as propane? Second, the quality and depth of its land or its acreage. 2 factors that determine the quality and depth of its acreage are: what are the asset break-evens? That means what price does oil have to maintain for that asset to be cash flow positive? Then secondarily, what is the average inventory life in years? Now there's 2 factors driving the calculation of the average inventory life, and that is an assumption about the number of rigs that'll be operating on that acreage, and secondly, the number of risk locations. The third factor that cannot be overlooked is understanding what assumptions are embedded within management's guidance about production and free cash flows. You need to know whether the assumptions are based on strip pricing, which is the current prices along the futures curve, or if the assumptions are based on some percentage of an index, such as WTI, or if it's based on some basis differential of an index, such as 15 cents above Henry Hub. The fourth factor is understanding production guidance and free cash flow and capital expenditures. Today, we're only talking about free cash flow and capital expenditures. In the case of capital expenditures, what we want to see is capital efficiency. That means the company can spend the same amount of capital and produce more product, or it can spend less capital and produce the same amount of product. One way that companies achieve capital efficiency is buying the best, highest quality acreage that allows for drilling long lateral lengths. That means drilling laterally underneath the earth, which it is more cost effective to drill horizontally and continue drilling horizontally than it is to drill new wells down vertically. So better quality acreage supports longer lateral lengths with wells that are more productive. They produce more oil or gas or natural gas liquids. In addition to CapEx, you must evaluate the stability of free cash flow. It is one of the primary drivers of valuation. From free cash flow, dividends can be paid, shares can be repurchased to increase your percentage of ownership of the company, and management can make investments in growth, whether that's through mergers and acquisitions or through organic production growth by drilling new wells and acquiring more acreage. The fifth factor is understanding the cash unit economics. First is leasing cost. Then you have GPT, which is gathering, processing, and transporting. Those are all separated cash costs. You had ad valorem taxes and general and administrative expenses, excluding non-cash stock-based compensation. Combining cost with average realized prices both before and after hedges, and particularly average realized prices after hedges less cash unit cost, will give you a sense for what the company is earning per barrel of oil equivalent or per 1,000 cubic feet equivalent. The sixth factor are the hedges. Hedges are the percentage of future production that has been sold, typically at either a fixed price or a narrow range of prices. Oil and gas companies will use either fixed price swaps or a costless collar. The most basic example of a costless collar is selling a call option and collecting the premium, and then using that exact premium to purchase a put option to create a floor on your price. It creates both a floor and a cap, and because you use the premium from selling the call to cover the cost of purchasing the put, it is a costless collar. You have to understand what percentage of the future production is hedged and at what prices to have a grasp of what kind of variability there will be in profits, free cash flow, so on and so forth when either oil and gas prices rise or even fall quite dramatically at times. Hedges limit some of that risk, but will also cap the potential upside. You have to determine how bullish or bearish you are on oil prices, or you could take the mean viewpoint and look at a company with some hedges that provides some downside risk along with some exposure to the upside. The seventh factor is leverage. Most oil companies have been paying down their debt. The key metric to compare leverage is net debt to EBITDA. A company with less than 1 times net debt to EBITDA is generally going to be considered pretty unleveraged. 1 to 2 times, maybe average leverage. Above 2 times is going to be more highly leveraged. An unleveraged company is going to have the ability to return more cash to shareholders or to invest in growth because it doesn't have to cover interest expense. Moving on, the 8th fact you need to compare is management's capital return framework. If you're looking for a more stable source of income, then you're going to want to look for a capital framework in which management has committed to return more dividends. Just know when you collect those dividends, you will be paying ordinary income taxes. Whereas if management has committed to a larger share buyback program, then you can participate in the price appreciation of the stock and defer any taxes as that capital compounds over multiple years. There are trade-offs, and you have to weigh which of those trade-offs is going to be more valuable for you and your situation. And the 9th and final factor is going to be the enterprise value and valuation. A few of the multiples that are used to value oil and gas companies are enterprise value to EBITDA, a free cash flow yield, or inversely a price to free cash flow. Also an enterprise value to a debt adjusted cash flow. And the reason it is debt adjusted is oil and gas companies' capital structures are significantly different. So some carry a lot of debt, others carry very little debt. And so a debt adjusted cash flow gives you a better comparison. And finally, oil and gas has a couple of unique forms of valuation, and one of them is enterprise value to 2P, that is proven and probable reserves. Proven reserves have a 90% probability of being developed, and probable reserves have a 50% probability of being developed. So you can calculate the enterprise value to the value of its proven and probable reserves. There is a limitation to this metric, however, because not all inventory is equal. So refer back to inventory depth and quality, and it does not cost the same for all inventory to be developed. And that is where you refer back to capital efficiency. Those are the 9 factors that you need to compare oil and gas companies this week and start making money in the stock market.